Welcome to Bruce Hurwitz Presents Meet the Experts. I'm your host, Bruce Hurwitz of Hurwitz Strategic Staffing. You can find us on the web at hsstaffing.com. I hope you'll consider us for all your staffing, career counseling, and professional writing needs. I am delighted to be joined today by Robert Klausner. We will be discussing tax preparations for 2023, what you need to know. Rob, welcome to the show.
Morning, Bruce. Thanks for having me.
It's my pleasure. You know, you come on every year, and I appreciate it, and you give us the low down or the high down, whatever you want to call it, for what we need to know for filing our taxes. And every year there are some new developments. But I want to start with a question I've never asked you before. What stays the same? What never changes?
There's always a taxing authority. that death and taxes are the two things you can always rely that will be there. They just change the form and the structure of how they do and the process.
Is there anything that you should always have in place for preparing your taxes?
Well, you should always, people wait, obviously, nobody likes to do taxes and everybody waits till February or March when they start getting their documents to think about it. But they really should be thinking about it throughout the year, because if something changes, if you have an odd transaction, whether it's a stock sale, a large stock sale, or a house sale, or a rental property sale, or something, any kind of major event that changes your income situation, you can find yourself, if you wait till February or March of the following year, the year is over, and you could find yourself owing quite a bit if you're not on top of it. And that could include penalties and interest if you're underpaid. But so people should be thinking about it throughout the year, and just as a, some people go through and are on automatic, and they pay their quarterly estimates, and that's fine. But when there's a special transaction, they should look at it at that time, because by the time you hit March, there's no planning left.
I thank you for that. Now I want to share a slide, which are the topics that we'll be discussing. And let me see if I can, here we are. So let's take them one at a time. Well, it's not bait and switch exactly, but bait and petet.
So those are just acronyms for the BAIT is obviously for the business alternative income tax. So this was something that came in 2019 after President Trump changed the state deduction, the itemized deduction for state taxes, state and local taxes. They capped it at $10,000 for people. So the states wanted to come up with a workaround, and a lot of the states came up with this, where if you are a member of a pass-through entity, either an S corp or a partnership, and it has to be partnerships have to be multi-member, can't be a single member. They will allow you to calculate the income from that entity, pay in quarterly estimates to the state from the entity, and then those payments will pass through to the shareholders as estimates so in this case is for the state of New Jersey. PTET is the acronym that all the other states use, and it stands for pass-through entity tax. So this was a workaround. So an example is if the company makes $100,000, the New Jersey tax is estimated to be $6,000. The company would pay in the $6,000 through estimates to the under the BAIT program, after making an election. It's an annual election that would then pass through when the return is done for that pass-through entity. The K1, which is the equivalent of a 1099 for the partnership, tells them what their share of the income and expenses are. Will also list a credit for New Jersey taxes for that $6,000. So when the shareholders prepare their individual taxes, they get to New Jersey, they would have that $6,000 as if they made a payment, a tax credit. In the meantime, the $6,000 reduced the federal income by that from 100,000 to 94,000. So you're saving federal tax dollars, and then it gets added back for the state level income, but because it's not deductible at the state level, but it does allow you to take the deduction then for those state taxes.
Is this related to the, I forget what it was called, the business about not being able to deduct your mortgage?
No, not your mortgage, your state and local taxes. It was a SALT cap, the state and local tax deduction limitation that so normally people used to be, prior to 2018, were allowed to deduct all of their real estate taxes on their primary and a secondary home, and then the any state and local taxes that were either withheld or remitted under estimates during the year. So that, for some people, certainly in the Northeast, is a very large number. The real estate taxes are the highest in the country, and our taxes are the highest in the country. So in 2018, under the TCJA Act, they put a $10,000 cap on it. So if you had $40,000 of real estate taxes, which is not unheard of here in the Northeast, and another $20,000 of state and local taxes you paid in, so that's $60,000. You were only allowed to deduct 10. So this workaround that now has been enacted by 36 states as of August of 23 allows the people, members of these pass-through entities, to take a deduction at the federal level in the partnership or the S corp, and it reduces the federal income for the people and then passes through as a credit.
But that's only if they own a business.
Right. It's only for unfortunately, the only way to do it was to allow it for pass-through entities. So, like I said, either an S corp or a partnership.
So there's no workaround for a private individual who's just an employee or a retiree.
There is not at the moment.
Okay.
The workaround will be electing a new president and getting a new tax law.
Simple enough. All right. Now, what is the Secure Act 2.0? So
the Secure Act was another one of these tax bills that came in. So there was the CARES Act that came in again in 2018. That was the initial, and the Secure was the initial plan. It extended the American Rescue Plan. There's all these, they have different acronyms. Each time they make an amendment or add to these plans. So the Secure Act 2.0 was part of that, and it had some key components that were delayed changes in the law. So that was put in back in 2020. So there was a lot of changes that are now kicking in, actually in 23 and 24 that affect most of its retirement changes, and but there was a lot of things that were hidden again or disregarded, I'll say, because people heard about it back in 2019 or 20, and they nobody's thought about it till now, because now it's kicking in.
Retirement updates.
So like I said, there's a lot of changes in the Secure Act that are mostly affect a lot of them affect the retirement ages and the distributions that are going to be allowed. Some of the most notable ones, obviously, there's increases every year that allow the amounts to be contributed to IRAs and 401ks and things of that nature. So in one of the things is that they are changing. So just trying to get to my schedule here. So the increases are going up. In 23, there was increases to retirement IRAs to 6,500 max. The employee deferrals, like to a 401k or a 403b, went up to 22.5. If you're over 50, there's a catch up of 7,500. So that's a total of 30,000 that somebody could put into their 401k or 403b. And there was increases on all the plans each year as we go along, in the different areas. So the most notable ones in the retirement area is that your retirement or the distributions for required minimum distributions from your retirement used to be 70 and a half. And the year you turn 70 and a half, you had to start taking what they call RMDs. The Secure Act raises that age to 72 in 2023. So that helps people with everybody living longer. They're not forced to take their money out of their retirement right away anymore. It's going to extend down the road to 75 eventually, but that's not for another 6 years.
This is all federal, not state.
Well, the states follow the federal rules as far as retirement distribution rules and for the distributions and when they have to take it. So there's no state that will tell you, oh, you have to take it at 70 versus the IRS is telling you 72. So it's but there's other things that are coming in. They're allowing IRAs contributions for graduate students starting this year. That in the past you had to have earned income, and graduate students don't often have earned income. It's either some kind of scholarship or tuition credit. So they're allowing the college graduate students to make IRA contributions. There's going to be required allotment for 401ks to allow part-time employees to participate in 401ks. That's a big deal, and for a lot of people. They're changing some annuities in the 401ks. They're allowing annuities now in 401k plans, which they never allowed before. And they took away the IRA contribution limits. There used to be a limit, like once you reach, if you're starting to take RMDs at 70 and a half or now 72, they used to say it doesn't pay, even though some people work beyond 72 and many people now, and they were limiting the amount you could put into your IRAs at that point, because since you're already required to take distributions. So now they remove that. They remove the age limit. As long as you're able to work and you have earned income, you can contribute to your IRA. So those are some of the major changes in the retirement plan under the Secure Act 2.0 and the retirement up. That's the retirement update. They really overlap.
Let's move on to the lower tier. From a tax perspective, because we could do an entire show on the difference between S corps and LLCs.
Right.
From a tax perspective, what's the difference between the two?
So an S corporation is a corporation versus the LLC, which is the limited liability corporation. So the limited liability corporation, the LLCs is the entity of choice for a lot of people starting out. It's the easiest to form. It's the easiest to maintain. There's no tax liability, federal or state. The allocations. The biggest difference is the allocation allowable. In an LLC, you can specially allocate every number in the return. If you have one partner maybe doing a lot of the sales or the work, and he get an extra commission, you can specially allocate additional monies to him under guaranteed payment. Whereas in an S corporation, whatever your ownership percentage is, that's how the allocations of everything has to go. So if you're 50-50, then it's 50-50. If it's, as opposed to the LLC. So those are the two major differences. The S corp also has minimum fees at the state levels in a lot of states. So there's a couple of, but there's also other differences in that the way they're taxed. The LLC income is subject to regular tax and self-employment tax on the entire amount. The S corporation is not subject to self-employment tax, only regular tax. So there was a few differences between the two that everybody should look at as to what works best for their situation.
Now, the LLC is not a partnership. That would be
an LLC can be a partnership, but it can also be a single member LLC. So if you open it by yourself as a sole proprietor and it's just you, there's no separate filing. It would be a Schedule C or Schedule E, depending on what it's doing on your personal return. So it would be separate. As an S corp, there is a separate corporate filing that has to be done, and it can be one member or 100. But the LLC can be a partnership if you have more than one person. It is usually taxed as a partnership.
Now to the alphabet soup. What are HSA, FSA, and HRA? And what's the
So,
difference between them?
okay, so an HSA is a health savings account. A The FSA is a flexible spending account, and an HRA is a health reimbursement account. So each of these has a different function. It's all related to obviously pre-tax for health benefits and or childcare. So they allow you this depending on your company, they may allow you to participate in these and fund these pre-tax. They all have different levels. An HSA is a health savings account. If you're in a high deductible health insurance plan, you can contribute to this and use the money as needed for to pay medical bills, and it grows tax free as long as you take it out with medical bills. So if you have a large, if you're in a high deductible plan, you can fund the HSA. It's up to 77, I believe it's 7750 for this year for a family, and like 3800 for an individual. You can fund that, and it'll grow over time. If you don't use it, it'll grow like an IRA, a deferred tax IRA. And as you incur out-of-pocket medical expenses, you can take the money out of there if you so choose to pay those bills. And so then you're saving, and that you're funding it through pre-tax money. And you're not taxed when you take it out, unless you don't take it out with using medical bills. And FSA was the first of these that was created, a flexible spending account. It had a small limit on it. It started out at like 1,500. I think it's now 2,500. This is a single year, again, pre-tax, to either pay your out-of-pocket medical, or even for childcare can be used. This has to be used by the end of the year, though. This is a 1 year thing, and then they allow you a small carryover to the following year. If you don't use it all, I believe it's $500. An HRA is another plan that the health reimbursement account, where I'll tell you, we have it here. One of if our employees go to the doctor, and we are part of a high deductible plan, so when they have an out of pocket medical expense, they will get reimbursed by the company through this plan for a percentage, depending on what their company's plan states.
Now, this solo 401k, I know what that is, but what's the SEP?
Right. So the SEP is a self-employed pension. It's the akin to an IRA for a self-employed individual. So if you are self-employed and you're either a single member LLC or even a sole shareholder of an S corp, you can set up a SEP. A SEP has a higher contribution rate than a traditional IRA, which is capped at, as we said earlier, about 6,500, with a catch up, with $1,000 catch up. But the SEP is a percentage. It's usually 20% of your net self-employment income. So if you make $100,000, you could contribute to a SEP theoretically for approximately $20,000 and take a deduction for it.
Can you, lack of a better term, double dip, have a 401k, have an IRA, have an SEP?
So you cannot have, there's a maximum, whatever the maximum one is. So the 401k is $30,000 cap. That would be the cap. So you can't contribute to a traditional IRA, or even depending on your income level, you may be able to contribute to a Roth or a non-traditional IRA in addition to your funding your 401k, but it depends on the situation.
Finally, the topic that I like the most, tax planning.
So as we've said in the last, there hasn't been a new tax law specifically for since 2018. Certain things change minimally for cost of living increases every year. So you want to look and see. We don't expect a new tax plan, obviously, until the next president, if that happens again. there are situations though where, like in this year, in 2025, there is a sunset provision coming for the current estate planning lifetime exclusion. So currently for 2023 and is about 12.9 million. So if you want to give away, everybody's running to make sure that they use up their exemptions before the end of 2024, because it's supposed to sunset and revert back to pre 2018 levels, which was around 5,500. 5.5 million. So a lot of the rich people are running to the lawyers to create trusts and do their gifting to make sure that they don't lose that, because they don't know what the next, if it'll be extended or if it'll be changed again in 20. It's set to sunset after 2024.
Is there any, excuse me, is there any limitation on to whom you can gift? Does it have to be, for example, a blood relative?
You can gift, obviously you can gift your money to anybody you choose. You're allowed, currently it's 17,000 per year per person, as an excluded amount. Once you go beyond that 17,000, then it goes in you're supposed to file gift tax returns and report the amounts you're giving to each person. But there is no restriction on who you give it to. It could be a relative, could be a friend, could be a stranger, could be a charity, could be anybody you choose.
Well, what's the difference between gifting to a charity and making a charitable donation?
Nothing. So usually you're going to gift to a charity, people leave it in their wills. Maybe they will, if they pass away, and they will donate, they will have their estate or a portion of their estate go to the charity. I've seen that many times where people want to either donate to their alma mater or to a charity, any charity, and they will the money will go, and there'll be still a deduction for the donation, whether it's cash or non-cash appreciated property or of some sort. So they can still, the estate would then take the deduction, but
so gifting to a charity is just making a charitable donation.
Yes.
Okay. Now, I want to thank you. As always, you have been concise, to the point, and understandable, most importantly. So I thank you personally on behalf of our viewers. And I want to put up your contact information. And I have one final question. Is there anything that I didn't ask you that you wish I had asked you? And if I had asked you, what would you have said?
Well, there's, unfortunately, we've been in, like I said, a fairly stagnant period of for the last 5 years with the tax acts and whatnot. But ask me what would happen, what if I have a major transaction, what's the first thing I should do? And I would say that the first thing you should do is contact your tax advisor and plan. Don't wait until the end of the year and then say, oh yeah, last February I sold this and had this huge gain. What can we do? That was one of my big stories with a client when I first started out. I would follow up with him and he never took my calls, thinking that I was trying to look for billable hours. And when we came to February, he came back to me and said he went through his stuff, he was gathering his tax stuff, and he noticed he forgot he had this transaction back the previous February, and he had this huge gain. What can we do about it? And I told him he could pay 20% now, and next time take my calls. And he, after that, he always took my call. So those are the things that people they don't think about it. They get all the money, they're all excited. And the first thing if you know the transaction is going to happen, talk before it happens, because maybe there's a better way to plan for it or structure the transaction even so it's better tax wise for you. So don't just run and jump at the money and take the deal as is when there may be a better way to structure it, whether either through deferral or through other tax methods and tax planning.
Now, the fact that things have been stagnant for the last 5 years tends to indicate that it's bipartisan.
Well, they just couldn't do it. They just couldn't get anything done, right? So after Trump passed the tax law, it changes in 2018. When Biden got elected, there was so much upheaval, and the Senate and the House were split, so he couldn't focus. He couldn't get a tax bill passed.
Yeah.
He had to do it in little pieces. So we'll see next year what happens.
Understood. Rob, thank you very much.
Thank you, Bruce. I appreciate it.
I'm Bruce Hurwitz. Thank you for watching. And as always, please stay focused on success.